this is very important as far as a developing country is concerned. So as far as India is concerned, the investment climate in India has improved a lot, improved really tremendously after the economic policy introduction, that is from 1991, when the government opened up the economy and initiated the LPG strategy, liberalization, privatization, and globalization strategy. So during that period, the FDI norms, which are very restricted earlier, the norms were totally relaxed and eased. So that has attracted many foreign institutions and foreign investors to invest in India. Many sectors were opened up by the government for foreign investment, partially or wholly, because there is certain limit, and the foreign investment cannot be 100%. So certain limit is there. Suppose some foreign investment will be there, it might be 25% or 30% or 50% of the capital they can invest. But in certain sectors or certain industries, government has allowed 100% FDI. Okay. So currently, as far as the FDI is concerned, India ranks in the list of top 100 countries, because the foreign investors, they feel that there is a ease of doing business with India. So that's why they are very interested to park their money and use their money or invest their money in Indian businesses. Okay. So if you talk about what is the amount involved in this thing, how much money has come into India. So last figure since 2019, if you take the 2019-20 figure, in India was the top 10 countries in the world which have received the quantum of foreign investment in India. So during this period, around $49 billion of foreign investment came to India as per the United Nations report. And this was more than what was in 2018. What is the total amount of investment in 2018? The increase of around 18 to 19% increase was there in the year 2019. Okay. And in say, so net FDI, which was there, it has increased a lot since then. In 2023-24, around $81.04 billion have been invested in India. In 2024-25, it has increased by 15%. It was increased by 15%, means almost $100 billion has come to India as FDI investment. So all this FDI investment, normally there are selected sectors for which the foreign investors are interested to invest in them. So sectors like mostly in the construction sector, in the defense sector, in the broadcasting sector, communication broadcasting sector, civil aviation, plantation, then banking sector. All these are the sector where normally these foreign investors are interested. They are sending money to India for development. Okay. So to ease of this foreign direct investment, normally it depends on how the foreign investors will be attracted. They look into different factors. What are the country's policy framework? What is the foreign direct investment policy? How much easier it is to do the business? How much easier it is? Whether there are so many barriers or restrictions are there or not. So that policy they will look into. If policy suits them, then they will invest. Then the country's rules with respect to entry and operations and functioning, means how the investor will come and they will invest their money, because they are acquiring the stake of business in a business entity so that they can have the day-to-day business operation and management, everything. So as regard merger acquisition and competition, what are the rules and regulation by the country's government? If they are good, they are favorable, they will do it. Then they will see that what is the political situation, what is the economic condition of the country, and what is the social stability of the country. If the country is peacefully going on, they will be interested. Otherwise, if there is some disturbance, political disturbance or economic disturbance is happening, then they will be not interested. Then how the country is giving treatment on the standards of foreign affiliates, how they are treating the foreign affiliates. Those people who are investing from outside, they are foreigners, how the country's people and the businesses as well as the government, they are treating this. If the hospitality is good, then they will be definitely interested. Then what are the different type of international agreements they have to enter into? And what is the trade policy of the country? Means regarding the tariff and non-tariff barriers. What are the barriers in tariff and non-tariff? That is also a part of the country. Then what is the privatization policy of the country? Whether the public sector are dominating or private sectors are dominating. Normally, if the private sector is open policy and private sector are welcomed for all these things, then they will be interested. So these are the different factors which determines that whether the country will get more foreign direct investments or not. Now certain rules are there how the foreign investment comes. Regarding that, we'll see that there are how the things will be decided, who allows it. There are two categories of route through which the foreign direct investment can come to our country. Two routes are there where the FDI flows into our country. So the routes are category 1 and category 2. In category 1, it is called automatic route. The name is automatic route. Automatic route means, I will let you know, where in this automatic route, almost 100% FDI is permitted. 100% FDI is permitted through automatic route. And in category 2, up to 100% FDI is permitted, but it is not an automatic route, it is through government route. Means government's approval is required. So that is the difference between these two routes. One is automatic route, another is government route. Okay, so automatic route means what? In the automatic route, the foreign entity who is interested to invest in our country, they are not required to have, they do not require to have prior approval of the government or RBI. It is not required. Prior approval is not required. They can easily talk with the business entity in India and they will be investing in Indian entity. But the thing is that they should inform or report it to RBI. Because RBI is the authority who actually does the things for government. So only thing is that they should follow the rules and regulation of this automatic route, and prior approval is not required, but only after the confirmation when they will be sending the money or they're doing the starting the business in India, then at that point of time they should intimate the entire thing to the RBI. Okay, so that is the only thing in automatic route. As far as the government route is concerned, this government route, the foreign entity should compulsorily take the prior approval of the government. So you might be saying, then what is the difference? Difference is that certain sectors or certain areas are there where they are allowed for automatic route, but they are allowed in automatic route. But certain sectors and certain industries are there where automatic routes are not allowed. In those things, government route has to be followed. Means compulsorily prior approval has to be taken. So in this case, how the approval process is taken, government route, the foreign entity should file an application to the Foreign Investment Facilitator portal. There is a Foreign Investment Facilitation portal is there. This is a through internet into the foreign FIFP, Foreign Investment Facilitation Portal is there. Through that portal, there is a application has to be filled in and submitted to the government, which is a single window clearance process. When the application is submitted, details of everything to be filled in by the foreign investor, then this application is automatically forwarded to the respective ministry or the respective department, which will be approving, either approving or they will be rejecting as per the eligibility. Either they will approve or they will reject the application after consultation with the Department of Promoting Industry and Industrial Trade. There is a department called Government Department of Promoting Industry and Trade, International Trade. Department of Promoting Industry and International Trade. There is a department. So in consultation with that department, either the application will be approved or application will be rejected. Okay. And we know that the FDI can be for three things they can be done. So for an investor, what they will do, either they will acquire the total company in India. So that is called acquisition, full acquisition of the company. They will take over the company, or it can be a merger also. Merger in the sense that already the foreign investor or foreign entity, they are doing some kind of business outside. They want to merge their company with the existing company of India. So merger of these two things can happen, or it can be through making a partnership. So three things are possible in FDI, FDI, foreign direct investment. Either they will be acquiring the entire company, or it can be a merger, or it can be a new partnership, which may be said. Okay. Now, while this acquisition, merger, and partnership happens, there are different types of FDI. We should know that what are these types of FDI. Means whatever the business they are forming, what they are called, according to the nature of business they will be doing. For that purpose, there are four types of FDI which might be possible. So those are very important. So sometimes question comes, so you should remember this. First is type of FDI is called horizontal FDI. Horizontal FDI. Horizontal FDI means under this type of FDI, a business expands its operation to another country. Means same type of business, the foreign entity is doing same kind of business in foreign country, but they want to expand that business in India. That means same kind of business they are doing. The business undertakes the same activity. There is no difference of activity. Whatever I am doing, say in USA, I am doing a business, same type of business I want to continue in India. So if that happens, that is called horizontal FDI. If that they will be putting that money and they will be expanding same kind of business in India, that will be known as horizontal FDI. For example, suppose in say USA, a business is done by a company who are dealing with say computer products. Some kind of computer products they are doing. They are dealing with computer products. And they want to do the same kind of business. Either they will find same kind of business which is happening existing, they will acquire that thing, or they will merge, or they will make a partnership in India's computer product stores in India. So same kind of business here in India, it will happen. Same product. So whenever these two things are same, that type of FDI is called horizontal FDI. Second type of FDI is called vertical. Vertical FDI is little bit different from horizontal. In here also same kind of thing, that the foreign entity wants to expand their business to another country, but it will be little different supply chain. Here the supply chains are same. computer program. But here what will happen? It will be little bit different. It is not exactly the same, but it will be somewhat related. If they are exactly the same, then it will be horizontal. But if like little bit different, then it will be called a vertical. For example, suppose in UK, one company is there. They are manufacturing, say, furnitures. They are making furnitures, different type of furnitures for office or for homes, whatever it may be. They are manufacturing furniture. Whenever they are expanding their business in India, they are actually not doing the same thing, manufacturing furniture, but they are into a business where they will be dealing with some wooden material, which are not furniture, but they are wooden material. They are somewhat related, but not exactly the same. In such cases, they are called vertical FDI. Okay. In third case, the third example is conglomerate. Conglomerate FDI. CONGLOMERATE. Conglomerate FDI. Under this FDI, a business is totally different. Whatever the business they are doing outside or foreign their own country, they will be entering into a totally different type of business. Means totally, there is no relation between these two. In 1 and 2, horizontal, vertical, there are somewhat some relation, but here it will be totally different. Totally different. Suppose they are dealing with, say, in the different country, they are dealing with, say, some fertilizer. They are doing fertilizer business. Okay. Now, in India, they want to go into some pharma business. So here, these two are totally different. When these two things are totally different, then that is called conglomerate. And fourth one will be called platform FDI. Platform FDI, here what happens, the thing is that whatever the business they will do, they might do the same business or whatever it may be, business, say X business they are doing. Here also they can do X business or they can do Y business, either same kind of business or different kind of business. But the purpose will be that whatever they are going to manufacture or deal with in India, the entire products, whatever they will be producing in India, all the entire output are to be exported to a third country. Entirely, the output will be exported to a third country. In this case, all the materials are to be sold in India. It will be used in India only. But in this case, platform FDI, whatever the output they are doing to do, what kind of business they are doing, whether the same activity or different activity, the output or the products which are they are doing, entire product has to be exported to another country. So in this case, these are the platforms. So you have to remember this: horizontal, vertical, conglomerate, and platform. What are the things? Okay. Is it clear? Any question on this? Then you have to know some other type of FDI has come recently. One is called Greenfield FDI. One is called Greenfield FDI. So in this type of FDI, it is a process where they will be creating a subsidiary in their foreign country. Means from USA, somebody want to invest in India, so they will be creating a subsidiary in India. So the parent organization will be there in USA, but subsidiary is created in the other country. So normally what happens? Only subsidiary they will be. So this way, the parent organization builds its operation from the basic foundation. Whatever they are in the foreign country, they are doing it in the So home country and foreign country. Home country is USA, foreign country is India. So basically, the organization, the parent company, whichever is there, they are starting to build the operation from the basic of the new country. Means, say, for example, also, whatever the business they are doing the same business in India, but in a subsidiary, they will open subsidiary in India. This is not about total acquisition or merger or partnership, but this is a subsidiary they are opening. For example, you must have seen the McDonald's, then say Hyundai India, Hyundai India, then say Pepsi India, Pepsi India, Coke India. So these are actually they are the McDonald, Hyundai, Pepsi, Coke. They are the original, let's say, parent organization, but they are operating in the same name as a subsidiary in our country. So in such cases, this will be termed as greenfield FDI. Okay. Another thing is called brownfield FDI. Brownfield FDI, what is this? Where a certain sum is invested by the parent organization in an existing facility in the foreign country for initiating the business process in that country. So we can look at this type of investment as a lease or purchase. Here it is either a lease or we can say purchase. Through lease or purchase, they are expanding that business in India. From other countries, they are expanding. So actually that already exists in foreign country, but they are doing the same through a process of lease or purchase. Like example, see, you must have heard about a company called Ranbaxy India. Ranbaxy India is a pharma company, was a pharma company operating in India for a longer period. For some year back, Ranbaxy actually sold the entire business to Daiichi Sankyo of Japan. So Japan totally purchased this company. So Daiichi Sankyo is a pharma company in Japan. And they acquired this, they purchased this Ranbaxy India fully. So in such cases, when such total purchase is happening by the company where they are dealing with the same thing, that is called brownfield. Okay. Sometime it might be possible that there might be a joint venture FDI also. There might be a joint venture FDI. Joint venture means with collaboration of both the countries, the company will be up. Like where the foreign company and domestic company will join together to share the investment, technology, profits, etc. For example, we have a company called Hero Honda. Hero Honda. Hero is Indian company. Hero was making bicycles earlier. Now Hero Honda is making the two-wheeler and other automobile thing. Hero Honda. Similarly, Kawasaki Bajaj. Kawasaki Bajaj. Bajaj was earlier the two-wheeler company in India. Now Kawasaki has merged with them. Both of them have started the joint venture Kawasaki Bajaj, two-wheeler businesses and three-wheeler businesses. They are doing this. So that may be called as joint venture. So that we have learned that there are 7 types of FDI. One is horizontal, vertical, conglomerate, platform FDI, then greenfield FDI, brownfield FDI, and joint venture FDI. So there are 7 types of FDI. You should, I hope the concept is clear. You can easily answer the question if whatever the question comes. Okay. So these are the things in the list. You see, these are the businesses which are permitted under FDI. It can be either automatic route or government route. And these are the prohibited activities. Means all these activities, there should not be any FDI. Government does not allow any FDI for this prohibited, like agriculture, plantation, atomic energy, lottery, gambling and betting, cheat fund, nidhi, tobacco-related products, housing and real estate, except for township and commercial project. So in this township and commercial project, FDI is allowed. Okay, housing and real estate. Okay, otherwise these are the prohibited list where FDI is not permitted. But other than that, in the left side row, you can see these are the sectors or these are the industry where government allows FDI from outside. Okay. The next thing about that, what is foreign institutional investor? So it is totally different from FDI. FDI means they want to control the business in India. They want to do the business in India. But foreign institutional investor is totally little bit different. So basically it means what? There are foreign institutions or investors, they will be interested to invest in other countries. So basically they are the investors only. They will be investors only, means they will be holding equity position, means only they will be interested to buy the shares of the company. So we can say that this type, other thing can be said, foreign portfolio investor also. Either it is foreign institutional investor or it can be foreign portfolio investor also. Both are same thing. So basically the difference is that here they will be buying the shares of the company. So buying the share means they have ownership, but they do not have any control on the management or day-to-day business of the company. Only they will be shareholder. Whenever the company gains profit, then they will be getting the dividend. Like any shareholder, if you have some shares, then you are the shareholder of that company and you can get the profit as a dividend. So similarly, FII and FPI are the same thing. So it can be, say, it is not that always there will be institution or firm, it can be individual also. If it is an institutional investor, then it is normally the hedge fund, some hedge fund companies or the mutual funds, insurance company, investment banks. They are the institution who actually they want to buy the shares of Indian company. Or it can be individual also. In case of individual, normally for this FPI term is used. Foreign portfolio. So there is a foreign portfolio investment scheme is there. Okay. So this is what. So FII is very, very important in all the emerging economies of the country because they bring funds and capital to the business of the developing country. So while doing that, so foreign institutions, what is required? They have to first register with the SEBI. They have to first register with the SEBI. Without registering with the SEBI, they cannot buy the share of Indian companies. So first thing is that they have to register themselves with the SEBI and they will follow all the rules and regulation of SEBI. Currently there are around 1480 companies who have been registered with SEBI as foreign institutional investor. Okay. So they either FII or FPI, foreign portfolio investment. Because of changes in the currency prices, foreign direct investments or foreign, say, have the potential, the foreign institutional investor have the potential to have more profit. Because of the fluctuation of currency, either they will gain more profit since dollar is gaining so much popularity and dollar is appreciating. So normally they will get the profit. But whenever it becomes reverse, they may lose also. They may suffer loss also. Reserve Bank of India monitors the entire FII and FPI of as well as FDI of our country. Okay. Here also the FIIs, NRIs, and PIOs. PIO is person of Indian origins. They are allowed to invest in Indian primary market and secondary market. Means primary market means either they can be buying the share through IPO, or in the secondary market means from the stock exchange they can directly buy also the shares. Okay. So through portfolio investments, they are allowed. But there is a certain limit which is there. There is a limit for the investment to be done by FII, NRI, and PIO. For FII, the maximum is 24% of the paid up capital of a company. For NRI and PIO, it is 10% of the paid up of, capital of that company. But in case they are interested to invest in a public sector bank in India, then that limit is 20%. So these are the three things you should remember. So what is the limit? Limit for FII and FPI is 24% maximum. If they are NRI or PIO, then 10%. But in case of they are interested to invest in a public sector bank, the amount is 20% for both of them. Okay. So what are the different types of things they can invest? It is not only equity shares. Normally it is about equity shares. Apart from equity shares also, they can also invest in debentures of the company, or they can also invest in the units of UTI or collective investment scheme. They can invest in, say, government securities, GSECs or government securities also they can invest. They can invest in the commercial paper of any company in India. They can also participate in the derivative market that are traded in the normally, which are traded in the stock exchange. Those derivatives they can also participate. They can also invest in the Indian depository receipts as well as security receipts. Security receipts are the instruments which are issued in case of securitization. Okay. So these are the, and also they can invest in the infrastructure company, infra companies also. So normally infrastructure company, they can invest in the instruments like non-convertible debentures, NCD, if they are infrastructure company. So these are the different types of instruments the FII can invest in. Okay. Now, what is the difference between FDI, FII? These are the, already I have explained to these things. I have prepared this table for your easy. So when I share this PPT tomorrow, you can go through this. So what are the difference between FDI and FII? For foreign direct investment and FII, what are the basic difference? What is the nature? What is the objective? What are the focus? What is the influence, control, regulation, risk? So all the things are given. I will share it tomorrow so that you can go through this easily. You can understand what are the basic thing of FDI and what are the basic difference between FDI and FII. Okay.